We do see the S&P just over 5,200. Of course, we know that is also your target for the S&P 500 for the end of the year, David. What would cause you at this point to boost that target?
Well, the target is based on fundamental analysis. And the way we think about it has the economy, earnings, valuation, and money flow. And so on that basis, our 5,200 target is what we're looking for. So in order for us to raise or lower the target, one of those variables would have to change. So the economic data in our assumptions are going to be reflecting growth of roughly 3%, a little bit less than 3%. Earnings are growing around 8%, and valuations currently are high. They're at an index level basis, almost 21 times earnings. And so the probability of a multiple expansion, while possible, is less probable. The idea of earnings being much greater than we're assuming, we think is pretty low. And then the question would then be money flow. So in that framework, economy, earnings, valuation, and money flow is suggestive and supports our analysis around 5,200, which is a target for the end of the year, which is, as you indicated, roughly a flat return from now till the end of the year.
Is there more upside or downside risk to your view at this point?
I would say there's probably more upside. The upside would be, for example, if the Federal Reserve was to cut more rapidly, more dramatically than we're assuming. The market is assuming somewhere maybe 1 to 2 cuts. The Goldman Sachs economics is looking for 2 cuts this year. So to the extent that that was to be front-loaded and you saw a cut in July, that would be supportive of potentially a higher equity market. That's not our base case. Our base case is, in fact, that the market will trade at around this level of multiple, or in fact even lower multiple, as we come towards the end of the year.